Welcome to the Deep Dive. You're here because you want to cut through the complexity and get straight to the actionable insights, and that's exactly what we're about. Today, we're tackling technical trading strategies, drawing on a fantastic collection of material you shared. We've got the foundational wisdom of John Murphy's 10 Laws of Technical Trading.
A classic.
Right. Alongside a range of focused articles from StockTarts.com, digging into specific areas like trading rules, moving average systems, the nuances of gap trading, and, this is interesting, the pre-holiday effect.
Yeah, that one's always a bit surprising.
Our mission is simple: to arm you with practical knowledge and maybe a few genuinely interesting observations about how traders try to navigate the markets using technical analysis, all while keeping it engaging, avoiding that information overload.
Definitely.
So with this rich set of resources in front of us, where do we even begin? It feels like a lot.
Well, what's fascinating right from the start, I think, is the consistent message across these different sources. Successful technical trading isn't really about chasing every little flicker on a chart.
Okay.
It's more about building a structured approach. It's like not enough to just know what a moving average is. You need a framework for how to use it, within a broader strategy.
Right. Context.
Exactly. And John Murphy's 10 laws really provide an excellent blueprint for constructing that kind of methodology.
Absolutely. His very first law, map the trends, that one really resonated with me. The idea that you absolutely must start by looking at the big picture.
A long view.
Yeah, the monthly and weekly charts to get perspective before you even think about the daily or intraday stuff. It's like trying to understand a river by just looking at one ripple.
Good analogy. You'd miss the current entirely.
Exactly. Murphy makes a strong case that even if you're a short-term trader, understanding that prevailing long-term trend is vital. Otherwise, you risk getting whipsawed, trading against the main force.
Which is usually a lower probability bet, statistically speaking.
Right.
And that leads perfectly into his second law: spot the trend and go with it. Now, this might sound obvious, trade with the trend.
Sure.
But the key is identifying the trend that's actually relevant to your specific trading time frame and then aligning your trades. So in an uptrend, you're looking to buy the dips.
Okay.
Downtrend, you're looking to sell the rallies. The sophistication here is using those longer-term parts to define the main trend, the overall direction.
The big picture again.
And then using the shorter-term charts to fine-tune your timing. When do you actually jump in?
Right. Okay, so once you have that trend in mind, Murphy's third law, find the low and high of it, brings us to support and resistance. Crucial concepts.
Absolutely fundamental.
These aren't just, random lines. They represent price levels where buying or selling has historically been strong. Support is kind of like a floor.
Where buyers stepped in before?
Yeah. And resistance is the ceiling where sellers showed up. Identifying these gives you potential zones, right? Buy near support, maybe sell near resistance.
Now, the really interesting part is how they can flip. If price breaks firmly through resistance.
It becomes support.
Exactly. And broken support can become resistance. It's dynamic.
So these levels give you potential turning points.
They do, and they tie directly into the fourth law. Know how far to backtrack. This brings in percentage retracement.
Ah, the pullbacks.
Yes. The 50% retracement is often highlighted as a really key area where corrections within a trend tend to stall out.
50% seems common.
Very common. But Murphy also points out that in an uptrend, looking for buy opportunities in the, say, 33 to 38% retracement zone can be a good starting point.
Okay.
And then, of course, you have the Fibonacci levels, 38% and 62% especially, which tons of traders watch closely.
Golden ratio stuff.
Sort of. The idea is that trends rarely move in a perfect straight line, right? They pull back. These retracement levels help you anticipate where that pullback might end, offering maybe a strategic entry point to rejoin the trend.
Got it. Then we get to actually drawing on our charts. Murphy's fifth law, draw the line. Trend lines.
Simple but powerful.
In an uptrend, you connect the lows. Downtrend, connect the highs. He emphasizes that prices often pull back towards these lines.
Like a magnet sometimes.
Yeah. And a significant break of that line below an uptrend line or above a downtrend line, that can be an early warning. Trend might be changing.
And he also notes, importantly, that the more times a trend line is touched, the more valid it becomes.
And the longer it's been in place. Makes sense.
Right. Building on that visual trend identification, the sixth law is follow that average. Moving averages.
Okay, now we're getting into indicators.
Yeah, more objective maybe. They average out the price over a set period. A really common approach is using two averages, different lengths.
Like a fast one and a slow one.
Exactly. And you look for crossovers. Short-term average crosses above the longer term. That could be a buy signal. Suggests upward momentum is building.
What call periods are typical?
Well, combinations like the 4-day and 9-day or maybe 9 and 18-day, they're pretty popular for shorter term stuff. Murphy also mentions the 40-day average as being significant.
Okay.
And this is key, remember, Murphy points out they work best when the market is clearly trending.
Not so good in choppy sideways markets.
Less reliable then. You can get a lot of false signals back and forth. Whipsaws.
Right, so Law 7, learn the turns, brings in a different type of indicator.
Yeah.
Oscillators, like RSI and stochastics.
Yep, these are designed to help spot potentially overbought or oversold conditions.
Meaning likely to pull back or bounce.
That's the idea. They usually run on a 0 to 100 scale. Common thresholds are like above 70 for overbought on RSI, below 30 for oversold. Stochastics might use 80 and 20.
And these can signal before moving averages.
Sometimes, yeah. They can give you a bit of a heads up that a turn might be coming. Another really key concept here is divergence.
Divergence.
Yeah, like when the oscillator is making new highs, but the price isn't following along. Or vice versa. That can be a powerful warning sign that the current trend might be running out of steam.
Interesting.
And importantly, oscillators tend to work fixed in trading ranges when the price is just bouncing around sideways, kind of the opposite of moving averages.
So different tools for different market conditions.
Precisely. And you can even use longer time frame oscillator signals to filter the shorter term ones, add a layer of confirmation.
Okay, that contrast between trend following and range-bound tools is really useful. And it sets up Murphy's 8th law nicely. Know the warning signs, focusing on MACD.
MACD. Moving average convergence divergence. It sort of combines elements of both moving average crossovers and that overbought, oversold idea.
How does it signal?
Well, a common buy signal is when the faster MACD line crosses above the slower signal line, and that happens below the 0 line. A sell signal might be the faster line crossing below the slower line, but above 0.
Okay.
Murphy also points out that weekly MACD signals often carry more weight than daily ones.
Longer time frame again.
Yep. And the MACD histogram, which shows the difference between the two lines, can actually give an even earlier clue about momentum shifts.
So lots of layers to MACD. Now, how do we know if we should be using trend tools or range tools?
Good question. That brings us to Law 9, trend or not a trend. This is where the ADX comes in, average directional index.
ADX, okay.
Basically, a rising ADX suggests the market is in a strong trend, so that favors using tools like moving averages.
And if ADX is falling?
That suggests the market might be range-bound, more sideways. In that case, oscillators might be more effective. So ADX helps you choose the right tool for the job, essentially, adapting your approach.
That's really smart, adapting the toolkit.
Yeah. And finally, Murphy's 10th law, know the confirming signs. This emphasizes looking at volume, and especially in futures, open interest.
Volume. Does price follow volume?
Often volume precedes price, is the saying. In a healthy uptrend, you ideally want to see volume increase on the up moves. Shows conviction, strong buying.
Makes sense. And open interest.
In futures, rising open interest during an uptrend suggests new money is coming in, supporting the trend. If open interest starts to decline, it could be a warning sign the trend is losing momentum.
So for strong uptrends, you want rising volume and rising open interest.
Generally, yes. That provides confirmation. And, while it's not listed as Law 11, Murphy definitely implies that mastering all this technical analysis, it's a skill. It takes practice, experience, continuous learning.
Absolutely. It's not a magic formula. It's a craft. Okay. That's a really solid foundation for Murphy. Now, shifting gears a bit, we also looked at Richard Rogge's trading rules. These feel more about psychology and discipline.
Very much so. Less about specific charts, more about managing the trade and yourself. His first rule hits hard. In bull markets, one is supposed to be long or on the sidelines.
Don't fight the bull.
Pretty much. He highlights that common mistake of trying to short a strong uptrend or selling winners too early. He admits even he struggled with selling too soon sometimes. It feels counterintuitive to just let profits run.
Yeah, that urge to lock it in is strong.
Rhodes really digs into that psychological side. Rule 2, buy that which is showing strength, sell that which is showing weakness.
Okay, so buy strong stocks, sell weak ones.
Yeah, and this goes against the grain for many people who try to buy things because they've fallen a lot.
The buy low, sell high mantra isn't quite what he's saying here.
Not exactly. He's more about buy higher and sell higher. Ride the momentum. He even suggests applying this within sectors. Buy the strongest stock in a group. Maybe avoid or short the weakest.
Interesting. Rule 3 and 4 seem to be about planning and adding to winners.
Right. Rule 3, treat each trade as potentially the biggest of the year. That forces careful planning, doesn't it? Entry, adding points, exit strategy, all thought out beforehand.
No impulsive trades.
Hopefully not.
Yeah.
And Rule 4 details how to add to those winners. He suggests waiting for minor pullbacks.
Like Murphy's retracements.
Exactly. Pullbacks to support in a bull market, maybe using those 33, 50% retracement levels, or even moving averages as potential re-entry spots. It aligns well with Murphy's ideas.
Okay. Then rules 5 through 8 seem to be all about patience.
Patience is a huge theme for Rhodes. Waiting for the right setup if you miss the initial move, letting winners run. This is where he challenges that old saying, you never go broke taking a profit.
He thinks that's bad advice.
He argues it can be. Constantly taking small profits means you might miss out on those really big trend-following gains that can make a huge difference to your overall results. You need patience to let trades develop.
Okay, so be patient with winners, but what about losers?
That's the flip side. Rules 9 and 10. Rule 9. Be impatient with losing trades. Cut them quickly. Preserve capital, financial, and mental.
Don't let losses run.
Definitely not. And Rule 10 is just as firm. Never add to a losing trade. No averaging down.
That's a common temptation, isn't it? Buying more as it drops lower.
Huge temptation. Rhodes insists any new buy in a long trade must be at a higher price. Any new short must be at a lower price. Reinforce success. Don't reinforce failure.
Got it. What else from Rhodes?
Rule 11 is core. Do more of what works, less of what doesn't. Seems obvious, but it means actively shifting capital towards your most profitable positions and cutting back on the ones lagging or losing.
Let your winners run, cut your losers short, basically.
That's the essence. Rule 12 is interesting. He suggests only trading when technicals and fundamentals agree.
Bringing fundamentals in. Not all technical traders would agree there.
Probably not, but it's his perspective looking for that confluence. Rule 13. Take time off after big losses. Avoid revenge trading.
Good advice. Emotions run high.
Definitely. Rule 14. Trade bigger when you're trading well. Make hay while the sun shines, basically. Capitalize on your hot streaks.
Okay. And Rule 15 gives specific guidance on adding size.
Yeah, add only maybe a quarter or half of your current position size. This helps manage your average entry price and lets the trade withstand smaller pullbacks without stopping you out.
Smart risk management.
Then he has that great line, think like a guerrilla warrior. Trade with the winning side. Don't try to be a hero picking exact tops and bottoms.
Love that imagery. Stick with the flow.
Exactly. And his last two rules are observations about market behavior. Tops often form violently and quickly, while bottoms tend to form more slowly, quietly.
Interesting.
And that the final 10% of a bull run can sometimes account for 50% or more of the total price move. That last leg can be explosive, but the initial stages might be slower, choppier.
Fascinating market dynamics. Okay, let's shift from those broad principles to something very specific. The last stochastic technique, or K39.
Right. This was presented as an alternative to the standard stochastic oscillator, which some find gives too many false signals, too much noise.
So K39 is meant to be smoother or more reliable.
The idea is perhaps more reliable signals. It uses a longer period, 39 periods, and it's unsmoothed. The signals are quite specific.
How do they work?
A buy signal happens when the K line crosses above the 50% level. A and D, the closing price, is above the previous period's high close. Both conditions needed.
Okay, a dual confirmation. And for selling.
Sell or short signal. K line crosses below 50%, and D, the closing price, is below the previous period's low close. Again, both parts need a trigger.
The examples help there, MSFT and CSCO.
Yeah, the MSFT example showed a potential buy, but also highlighted that you can still get whipsaws. Confirmation is key.
Right.
The CSCO example showed it capturing a longer trend, and interestingly, the article suggested using on-balance volume, OBV.
Volume again.
Yep, OBV with a 30-day moving average on it as a potential confirming indicator. An OPV crossover could help validate the K39 signal.
But it also mentioned adjusting settings.
Crucially, yes. Like any indicator, the settings might need tweaking for different stocks. Some volatile tech stocks might need different K39 thresholds, like maybe buy above 40, sell below 60, instead of the standard 50.
So no one-size-fits-all.
Definitely not. And for really volatile stocks, using maybe a second price indicator or sentiment indicator plus volume for extra confirmation is probably wise.
Good point. Now, Arthur Hill brought us back to the bigger picture, didn't he? Aligning strategy with goals and style.
He did. Using that football team analogy, you tailor your game plan. It's about fitting the strategy to you.
And he broke it down into goals, style, and strategy.
Right. Goals first. What's your risk tolerance? What kind of return are you aiming for? They're linked, right? Low risk usually means lower potential return. Think treasury bonds. High potential return often comes with higher risk, maybe growth industries.
Makes sense. And style.
Style should match those goals. If you want income and safety, you probably aren't day trading volatile tech stocks, right?
Sure.
He mentioned different styles: day traders, swing traders, few days, position traders, weeks, longer-term investors.
Each with different time commitments.
Exactly. Day trading needs huge commitment. Your style has to fit your life and your goals.
And then strategy is putting it all together.
Strategy is the how, based on your risk appetite, your style, your commitment. Hill gave an example, aiming for 20–30% annual return. That's high risk, so maybe use only a small part of your portfolio.
Huh.
His example strategy used position trading, 1 to 8 weeks, end-of-day charts, a select few indicators, candlesticks, patterns, PPO, slow stochastics, accumulation distribution.
So not trying to use everything.
No, keeping it focused. And critically, strict money management, stop losses, exit plans, maximum capital per trade.
And he mentioned separate portfolios.
Yeah, which would be a smart idea. Maybe one portfolio for aggressive trading, another for more conservative long-term investing. Helps manage risk and, importantly, emotions.
Keep the gambling separate from the investing, perhaps?
Something like that. It compartmentalizes the risk.
Okay. Hill also talked specifically about moving average crossovers.
He did. The basic system. Shorter average crosses above longer average, that's a buy. Shorter crosses below longer, that's a sell. Simple concept.
But
Shorter averages react faster, giving more signals, but also potentially more false signals, especially when the market isn't trending strongly. Whipsaws again.
the examples showed that, right? XIRC and 3Com.
Exactly. The 3100 EMA crossover on XIRC had some good entries, but gave back profits on exits sometimes. The 2060 EMA on 3Com, even with added percentage filters to reduce noise, still got chopped up.
So what's the takeaway on crossovers?
Hill's conclusion was pretty clear. They can be useful, but probably shouldn't be used in isolation. Combine them with other analysis, definitely use stop losses or trailing stops like parabolic SAR perhaps. And always remember, past performance isn't predictive.
Good reminder. Okay, finally, we get to gap trading and the pre-holiday effect. Let's start with gaps.
Gaps. Just areas on the chart where the price jumps between one period's close and the next period's open. No trades happened in that price zone.
And there are different types for trading.
The article focused on 4 practical types for trading. Full gap up opens above prior high. Full gap down opens below prior low. Partial gap up opens above prior close, but not the high. And partial gap down opens below prior close, but not the low. Less about the traditional names like breakaway or exhaustion, more about the immediate setup.
And the strategy relies on discipline.
Absolutely. Discipline, entry-exit rules, risk management is key. These can apply to gaps on any time frame, weekly, daily, intraday, and sometimes a short gap signal can even be an exit for a longer-term position.
So what are the actual strategies?
There are 8 main ones, detailed a long and a short strategy for each of the 4 gap types. The general rule is to wait for the first hour of trading, after 10:30 a.m. EST usually, to establish a range.
Okay, let the dust settle a bit.
Yeah, right. Then, for example, a full gap up. The long entry is a buy stop maybe 2 ticks above that first hour's high. The short entry is a short stop 2 ticks below the first hour's low.
Specific rules. Examples were CMGI long, GE short.
Yeah, and similar rules for the other gap types. Crucially, it emphasizes using trailing stops, maybe 8% for longs, 4% for shorts, adjusted as the trade moves.
Risk control built in.
Essential. It also mentioned applying this end of day, using daily or intraday charts, and that volume confirmation on the gap day helps. Gaps breaking support or resistance are often more reliable.
And there was a modified method.
Yeah, for more experienced fast traders dealing with high volume stocks, it involves trying to enter during the initial rebound, maybe around the midpoint of the open and the first hour's high or low, often using mental stops. More aggressive.
How do you even find these gapping stocks?
The article mentions scans on sites like stockcharts.com, other resources too. But always, always check the longer-term chart context. Look at support resistance. And maybe start with stocks, with decent volumes, say over 500K shares average.
And test it first.
Paper trading is essential. Log everything, entries, exits, hypothetical commissions, slippage. See if it actually works for you. The goal isn't perfect tops and bottoms. It's consistent profitability through a structured approach with managed losses.
Okay, makes sense. Lastly, the pre-holiday effect. This sounds quirky.
It is a bit quirky, but there's historical data behind it. It's this observed tendency for stocks to behave somewhat predictably in the day or two before major holidays, 9 of them listed.
What's the behavior?
Generally, a tendency to dip slightly before, maybe offering a buying opportunity. The strategy has historically been buy a day or two before, then sell either shortly after the holiday for a short-term trade or hold till year-end for a longer-term play.
And the theory is traders selling before the long weekend.
That's the common theory. Selling to avoid holding risk over a 3-day weekend when bad news could hit. This selling pressure creates the dip.
Does the data back it up?
The S&P 500 data over 50 years showed some positive average returns for these pre-holiday buy strategies, especially holding till year-end for holidays like President's Day, Memorial Day, Thanksgiving, etc. There was even a comparison suggesting the strategy might have beaten buy and hold significantly from 1928 and 1975.
Wow. So how would you trade it?
Short term. Buy a day or two before, sell maybe the day after the market reopens. Examples like GE, Motorola were given. But caution was advised around partial trading days, like before July 4th or after Thanksgiving, low volume potential volatility.
And the long-term version.
Buy on that pre-holiday dip, aiming to capture a good entry point due to that temporary selling, and then hold the position until the end of the year. Examples from 2000 Memorial Day showed potential good entries for long-term holds using this idea.
Fascinating stuff. So quite a range we've covered.
Definitely. From foundational trend following to specific tactics like gaps and holidays.
So as we wrap up this deep dive, it's clear technical trading isn't just one thing. It's a whole toolbox, isn't it? Ranging from those core Murphy principles, finding the trend, using support resistance, right through to these more niche strategies like gap trading or that pre-holiday effect.
Absolutely. And while we've, dug into a lot of detail from these sources, it's really important for you listening to remember this is just scratching the surface.
An introduction, really.
Exactly. Each of these concepts, drawing trend lines precisely, the different parameters for oscillators like K39, how to properly calculate those trailing stops for gaps. You could spend a lot more time on each one.
For sure. So the crucial next step for you, the listener, is to think about which of these approaches, these philosophies, maybe even specific indicators, actually resonate with you.
Yeah, what fits your goals? Your tolerance for risk? How much time can you realistically commit? A day trading gap strategy requires way more screen time than using weekly MACD signals, for example.
That's a great point. It has to fit your life.
Which leads us to that final thought for you to mull over. Out of everything we discussed today, Murphy's laws, Rhodes rules, stochastics, moving averages, gaps, holidays. What specific technical tool or trading rule seemed the most intuitive, or maybe just the most intriguing?
What sparked your interest?
Right. And what further reading or paper trading might you do to explore that particular area in more detail? How could you test it out for yourself?
Because ultimately, getting a better handle on market movements through technical analysis, it's an ongoing journey, isn't it? Constant learning, constant refining.
Always.
We really hope this deep dive into these different perspectives has given you some valuable insights and maybe some new tools or ideas to think about as you navigate the markets.